behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Scott Ladner. He is the CIO for Horizon Investments down in Charlotte, North Carolina. Scott, happy holidays to you and welcome to the program. I want to get your thoughts on something that I'm quite curious about. You have an S&P 500 up over 16% for the year. What would you tell an investor or an individual actually who wanted to start investing in the stock market right now?
Hey, Todd, first of all, happy holidays to you too. Appreciate you having me on again. Look, this is still a market to be bought. And the reason why it's still a market to be bought, if somebody's new and wanting to get in, it's still a pretty good time because people always think about, hey, listen, I don't want to buy at all-time highs. But by far what the most likely thing is? The next thing to happen is either a 5% pullback, a 10% pullback, or another all-time high. It's another all-time high. The stock market is not a mean reverting system. In other words, it's a trending system overall through decades and decades and decades. And so, just because you're buying it at what is today an all-time high, the probabilities are in your favor that you're going to get another all-time high shortly thereafter. This is not only a market that is that is trending well, that all the technicals are sort of in place, but it is really, really well supported by fundamentals. There's been a stock market rally this year that's been like almost all due to earnings, not because of multiple expansion.
Yeah, no, I do agree with that. What about the thesis, though, that the markets are rallying, not just because of earnings, but also because of the Fed? You have an easing cycle. You have a change in leadership that's about to happen in a few months within the FOMC. And it looks like whomever goes in there into that position is going to be more dovish anyway. And we'll probably have an aggressive rate cutting cycle to look forward to. How much of that part of the equation is built into this for Wall Street traders right now? Or do you think we're just focused on earnings going into the new year?
So, I think actually, Todd, we're getting in the point of the cycle where the Fed is boring and frankly mostly irrelevant, which is really actually a really nice place to be because it's one less thing you got to worry about. I'd actually take a little, not umbrage, but I don't think I'd agree with the statement that the Fed's going to have an aggressive easing campaign next year. If you look at how the market's pricing this thing, we're basically priced for one more cut. Like one more cut sometime in the summer. That comes from not only just kind of futures based probability stuff, but also like what the option market and interest rates is telling you. There's a very large, everybody talks about the VIX in terms of like equity volatility prediction and equity volatility forecasting and kind of what's in the price of options. But there's a massive market. I used to run a swaption portfolio for a bank here. There's a massive market for interest rate volatility and interest rate predictions essentially. What that market is telling you right now is, we think that the 2-year rate's going to move like 4 basis points a day for the next 6 months. That's on par with what we saw for most of the 2010s, which is a period of time through which the Fed really wasn't very active. They weren't doing a ton. We were sort of stuck at zero for a long time, obviously through that period. But this is not a market that needs the Fed to continue to cut in order to gain to continue to having good gains next year. And really, if the Fed is mostly on the sideline coming into next year, that will ultimately be a pretty good thing because it'll let people plan, and it'll just take one more thing that could go wrong out of the equation.
That's a very smart point. And so if I just to correct or just to understand, I said or correct myself, I want to know, are you suggesting then we're not going to be seeing another rate cut probably for at least 5-6 months down the line?
Yeah, that's our best guess. I mean, look, it's possible to get one in January. We are getting all these data. It's like everything is sort of at a lag right now. We got CPI recently, and that's there's a lot of questions about like how good were those data? Like, is that really real? But really, we're in a tough spot here from a macroeconomic standpoint, and the numbers standpoint, and from a data dependency standpoint, really until we get to March or April next year. So, I don't think they'll cut in January, but it's certainly possible. But even if they do, look, again, we think, one, maybe 2 more cuts and we're sort of done. One of the bigger risks to this market is going to actually be, we think, if Trump really does try to politicize this Fed and really tries to push on them to do things hard. Look, history is really on the side. I'm going to talk about this in our webinar for our clients here in the coming weeks. Like, history's on the side of like, listen, if Trump wants lower rates, the last thing he should be doing is trying to get in the way of the Fed. Because every single time that a central bank has been politicized over the last 40 years around the world, the result is every single time rates are up and currencies are down. So like it's just the wrong thing to do. If Trump wants lower rates, it's not, like going out to the Fed is not the right way to go about that. So that's something that we hope doesn't happen. We think he'll we don't think he'll get too super aggressive on that, but it is one of the things we're actually watching for risk wise next year. One of the things that could like derail the train.
That's interesting. That's another smart comment. So we'll keep an eye on that one. Let's shift to the leadership in the market. There is a lot of discussion now about the rotation out of the Mag 7 stocks because there was so much leadership. There was so much of an acceleration in valuations throughout the year, as we've seen actually the past few years. But what do you think about that right now? Would you start peeling back a little bit from the Mag 7 and look for maybe a broadening of leadership?
Todd, like that is sort of like what everybody is seeming to look for coming into next year, and that's actually something that we've been talking about for about a month now, and it's something we're looking for as well. And look, this isn't. I want to be clear, like this is not a situation like 1999 or 2000 where like the Nasdaq over the next 3 years was down 80%, and it was down 80% over those next 3 years because basically the prices of the stocks were not supported by the earnings of the companies inside the or at least the top of that index. That is not today's Nasdaq. That is not today's market. These stocks at the top of the Nasdaq, the top of the S&P, make money hand over fist, have massive margins, really stable businesses, and are growing earnings and revenue at 20, 30, 40% compounded rates over the last few years. Like these are great companies. But let me kind of start with like we don't want to be short those names. We don't want to not be invested in those names. Like I think you need to have some money in those things because they are still basically the best companies in the world. But what we have seen over the last couple of years is, Todd, and you're well aware, and many listeners are well aware, is we've had a leadership issue in the stock market where just the top of the market is dominated, and the top of the market is those big Max 70 kind of things, and but again, that has been for a reason. They've been earning the most money, they've been expanding margins at incredible paces, and the rest of the market just hasn't had a whole lot of growth. You haven't seen earnings growth or revenue growth, frankly, from basically the 493, like the other non-Mag 7 names in the S&P. We're starting to see that though. The reason why we're starting to see it is because we're coming into basically a fiscal boom next year with both from sort of tax cuts, from capex depreciation, from individual tax cuts, from deregulation that's really going to frankly hopefully finally get started in this next Trump administration that we've not seen thus far. We've got a lot of tailwinds at our back, and those tailwinds mean nominal GDP growth gets a boost. And anytime you get a boost in nominal GDP growth, those laggards, basically the cyclical stocks, the smaller stocks, the non-Mag 7 stocks that are starved for growth, those are the ones that actually get a bid. And that is what we're seeing. So we think this rotation is actually finally going to happen. We think this market does broaden out next year, but it's because we're getting a nominal GDP boost, and basically nominal GDP thrust coming out of both policy and some of the programs that we're getting. So that's the rationale behind it for us at least.
No, I understand. That's another good point. So, are you fearful though, and you bringing up Trump with the midterm elections next November, if there is a shift of power in the House, do you think that optimism might be challenged though as we go into the final 2 years of Trump's presidency?
Yeah, look, and Todd, you bring up a good point. Like this, if you're going by the cycles, like I mean, like presidential cycles or seasonality with respect to stock markets and presidential cycles, 2026 is the year that it has the most trouble. So like if you're looking for the fly in the ointment, like next year, like historically at least, the midterm year is like the worst year of the 4 year presidential cycle. And so that is sort of it's in our mind. It doesn't rule the roost, but it's certainly on our mind. And if as predicted right now, it's looking like right now, like the Trump, the Republicans are going to lose at least the House and possibly the Senate, probably not the Senate, but at least the House. Then you got a divided government, and then you got more of a lame ducky kind of Trump presidency for these last couple of years. Probably wouldn't be helpful, but we don't think that that's really enough to really derail things unless you get a kind of a clean sweep and he gets impeached and like you basically just get a whole bunch of noise coming out of Washington that's really sort of distracting from the purpose of government. Really, it's kind of slowing everything down. So like that could be messy, but we don't think it really changes the fundamental story for us, at least for next year.
Okay. So I know how you feel about the markets and I know how you feel about tech. Horizon you're introducing a number of ETFs. Are there any other non-tech themes that you are favoring in 2026?
Yeah, I mean, look, we talked about it just a minute ago. It really is a sort of broadening out trade in the cyclical stuff. So, like we do think those are the best opportunities in the market. If you want to pull back, like really the story of the economy and therefore sort of the market for the last couple of years has been the building up of AI capabilities.
Mhm.
What we really think sort of starting next year, the story is really going to transition from the building of those capabilities into the diffusion of AI throughout the economy. And so if you think about what it means to have a technology diffuse throughout the economy, throughout an economy, what that means is, different types of businesses are picking up, those potential productivity gains, essentially turning like the potential energy of productivity into kinetic energy of productivity. Inside of businesses around not only this country but around the world. We think that does that sort of like broadening productivity shift and that broadening out of the use, who can use AI and how can they actually use it in their businesses will drive
Mhm.
sort of these larger scale productivity gains across the economy, and that will allow some of these other companies that are not named the Mag Seven to really kind of catch a bid and improve their own margins, improve their own growth. And so that's sort of broadening out theme in terms of like especially the cyclical side of the economy when you have a nominal GDP thrust like we think we're getting next year. We think at least for the first quarter that is going to be like a better place to be than some of the tech heavy stuff.
So the Horizon ETFs, they're available for trading now, correct?
They are, yes, yeah. We've launched 12 this year. We've gone from 0 to 12. We weren't in the ETF business in March last year, and now we've got 12 of them with
Wow.
about $2 billion, a little over $2 billion inside of them so far. And look, we don't launch ETFs to be kind of like hot dotty or try to like get the next trend or get something sort of cute. We launched them in furtherance of our mission to basically build portfolios to power financial plans for individuals. And so as being a goals-based investment advisor and goals-based investment manager. And so like each one of these things sort of has a purpose inside of them, and so that's and they fit inside of a financial plan or a portfolio that's driven by a financial plan in a sort of logical way. And so we will continue to launch some next year, but they'll probably be a little bit more thematic. We are looking at something having to do potentially with like with some insurance related types of attributes, something that would be very focused on inflation, a couple other things like that. But the bulk of our work on the ETF side was really done and created this year, and we're really thrilled with the uptake that they've gotten so far.
That's fantastic then. And I assume that the ETFs cover a variety of different sectors, different industries. And I mean, you tell the audience.
Yeah, they do. I mean, it is the preponderance of them are domestic focused.
Okay.
Many, most of them have some sort of option overlay. We do a lot of things with derivatives here. We have a lot of people that have derivatives experience, derivatives trading and structuring experience on the team. So we do lean into that. And they're, these are largely systematic types of strategies. So, they have a high degree of what we call expectational certainty with respect to how they're going to perform in different types of markets. And that's important to us as we're building, products that can support a financial plan. There's one out there that's called a Digital Frontier ETF that we launched. There's a more focus on AI, more focus on quantum computing and crypto. Basically, like tries to answer the question, how do I invest in AI or how do I invest in sort of some of these digital frontier types of moves like quantum computing and crypto stuff. And we try to just like package that all into sort of one ticker that we can then use to have people be able to just buy that thing and answer that question. And that is a dynamically managed, has a systematic backbone, but there is some discretion that we carry on top of that in order to make sure that we're catching like the next trend for early.
Wow, that's amazing then. So let me ask you this. So you're only going to offer an ETF that you find a sector that or just a space in the overall market that you feel is going to do well, obviously. So what are your thoughts on offering a short ETF where you're shorting stocks in other words, which sectors are out there that you would actually want to stay away from, but you might take advantage of it by maybe shorting those equities.
Yeah, I mean, we think actually, typically this would be the point in the cycle. If look, if you heard me, we've been talking about a nominal GDP thrust and sort of good growth dynamics for next year. Usually, in a market like that, you would want to be short utilities. Right, I mean, like the boring old kind of like Utes things, and because in a hot nominal growth environment, you expect interest rates to go up, and therefore bond prices to go down, and utilities kind of trade like bonds. So like a whole lot of things would generally be going against utilities in an environment like this. The caveat to that one is you got to be careful of which types of utilities you're going to be shorting because there is a massive infrastructure build out going on right now that we think has got another 2 years to go. And utilities, especially electric utilities, are an important part of that. So you got to be a little careful with just broadly shorting the utility space. We think because of that sort of megatrend that's underneath that. But the more obvious one for us would be staples. Consumer staples really only win when you get a recession or when you get big inflation. We don't think either one of those things are really in the cards for 2026. So if I was going to pick a sector that we'd want to be, probably the highest conviction short on the board for us and sector-wise in the United States would be consumer staples.
Wow. Okay. Oh, that's some great knowledge then for the audience. So are all this webinar you have coming up, and I assume the ETFs, everything is on horizoninvestments.com?
It is, Todd. Yeah, I mean, people can come to that website, take a look at us, check us out, see what you think. We do post that webinar. We do release it to clients first, but then we do post it on there, shortly thereafter. So if anybody is interested in what we have to think about the world, welcome, come by, and we'd love to chat with you.
Well, that's beautiful. Well, I know this show is airing live right now, but when it airs on BTT, we'll have on the bottom graphic here, horizoninvestments.com. So if you're out there driving your car right now, don't bother writing it down. So, Scott, I got to thank you for joining me today. I know you're busy. It's year end, and you have a lot going on with the family in Carolina, but I do appreciate you taking some time today to join me, and I can't wait to have you back in the new year.
Always a pleasure, Todd. I really appreciate the invite as always. It's great to talk to you.
Thank you. Absolutely. And on behalf of Scott Ladner, I am Todd Schoenberger. Joining us at 12 o'clock, you want to catch the debut of WaveWire with Reese Williams. He is the portfolio manager at Wave Capital. That should be a can't miss episode that will be airing shortly. So we will, but until then, we'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.